Okay, today's bank is Citizens and Northern Corporation. It is based in Pennsylvania, and its geography is kind of isolated to that area, I believe. But so we can take a look at, let's see, our finance profiles we usually do. So, most banks saw an up and down for most of the year, and then after that, there's a divergence. Some of the banks go up, some of them go down, some of them kind of stay flat. Looks like Citizens and Northern kind of stayed flat there, and we looked at it last year and we decided not to buy. It looks like that was probably a good decision, but it's on the smaller side, so 260 million market cap. It's pretty low. As far as the PE ratio of 11, it's about a 9% earnings yield, so that's pretty low. Not egregiously low, but fairly low. We usually look for somewhere between like 9.5 to 11% earnings yield, so 9% earnings yield's a little bit on the low end. On the statistics page, you can look at the price to book. So the price to book's about 1 times. So that's pretty much in the average range of what we normally see for most banks. So that's interesting. So maybe average priced on its book value, its net assets, but priced on its earnings, maybe a little bit more expensive than the average bank. And we can come down to some of the earnings. We can see 0.94%, 8.97%. The 0.994 is pretty average. I think we usually see somewhere like 0.85 to 1.05, something like that on return on assets. So pretty average. Return on equity might be a little bit on the low side, but not by a whole lot. So seems like it, based on this, it might be an average profitability bank, and then perhaps a little bit of an average priced bank. So could be an interesting analysis to see if it's something that we would want to buy. So let's dive in. We can see its ticker CZNC, so that's what you can use to search for it on different financial websites. As far as the balance sheet goes, we've got 46 million of cash. That's not a whole lot at all. That's less than 2%. So not a whole lot of cash. But they do have about 405 million of securities, and that's about 16%, and that's pretty average. So low amount of cash, about average amount of securities. We notice they're all available for sale securities, so that means they're basically at their fair value. A lot of banks will have some held to maturity, right, that are at the amortized cost. And so that sort of skews the price to book ratios, right? Because some of the securities might not be at their fair values, while this bank, all of its securities are at fair value. So comparing those other banks to this bank becomes not an apples to apples thing. So, but we kind of clear that up a little later once we get into what are the fair values of the assets on the balance sheet. Anyway, so then we've got loans. About 1.8 billion here, and that works out to about 74% or so. It's a little bit on the high side, but somewhat in the average as well. So pretty average balance sheet we have here. Aside from maybe the cash being a little bit low, but perhaps some of the maturities of the securities or loans will kind of help shore up some of that cash. And yeah, so very average balance sheet. So perhaps, or average, asset side of the balance sheet. So maybe that would mean that they've got a pretty average interest income. So we'll see that once we get into the income statement, whether that's the case. But coming down to the liabilities, we can see about almost 500 million of non-interest bearing. Of course, we would want to have as much non-interest bearing deposits as we can. This works out to about 21%, almost 22% of liabilities, which is pretty average. So it's about the right in the middle of what a typical bank might have. So as far as the debt goes, they've got some long-term FHLB advances. I believe they also have the short-term borrowings, I think, are also FHLB advances. So, the debt works out to about 10% of the liabilities, which is a little bit on the high side, but, not egregiously so. So, depending on sort of the compensation of, the interest-bearing accounts, it seems like the liability side of the balance sheet is also very average. So, maybe there's a pretty average net interest income here, and that would be really awesome to have. So, yeah, no preferred shares or anything that we need to consider either. So let's get down to the income statement. We can see about 30 million of interest income, and that works out to about 5.26% yield on return on assets, or interest income divided by the assets. That's pretty average. It's higher than it's been for the past year for most banks, but over the past quarter for the ones that we've been looking at, that's pretty average, and that's great. So then we've got interest income of 11 million, so that's about 2.02%. That's right in the range of what has maybe banks over the past year have had. So, but over this past quarter, we've seen banks with 3%, 4% types of interest expense relative to assets, right? So I feel like actually the interest expense here might be a little bit lower than the average bank for this quarter now. So, and that translates into 19 million of net interest income, which is about 3.01%. So 3%, that's usually what we look for a bank on net interest income, is about 3%. So, wow, I guess, our thought process was correct, that we've got a pretty average asset side, pretty average liability side, so that's resulted in a pretty average net interest income. So that's awesome. As far as the non-interest income, we have 6.7 million, and that's about 18%. That's a lot higher than, maybe not a lot higher, but that's higher than the typical range that we see. We typically see 10 to 13% or so. So, they're making more money on the non-interest side as a percentage of revenue than the average bank. It looks like because they've got a lot of ancillary services, right? So trust revenue, brokerage, insurance revenue, that type of stuff. So that, adds to the bottom line. And, as far as non-interest expense, about 18.3 million. And that works out to about 49%, which is actually on the high side. We normally look for something between 40 and 47%. So actually they've got a little bit more non-interest expense than we might see for most banks. Of course they've got a whole lot of different ancillary services that they've got to pay, additional costs for than the average bank. But, that's kind of on the high side. So I hope that doesn't, offset the great things that we've got up here, which is, pretty average net interest income, better than average non-interest income, but then, worse than average non-interest expense. But, all that together comes to 5.3 million of net income, and that is about 0.84% return on assets. And that's in the average range of what we see. So the average range right now is about 0.8 to 1.05% return on assets. So this bank being 0.84% is within the average range. It's a little bit on the low end, but it's within their average range. So, you could say, this is about an average profitability bank. So, I feel like if the price is good, we definitely be down to buy an average bank, right? And if we compare the current market cap, which is about 260 million, maybe what was it, 259? Yeah. Compare that to the net income annualized, which it looks like it'd be about 20 million or so, multiplying it by 4. That gets us about an 8.18% earnings yield, and that's lower than what we would want to make. So that's unfortunate. We've got basically an average price bank, an average profitability bank, but a bank that's priced higher than the average bank relative to those earnings. So, there's a lot of banks out there that are good banks that are yielding 9.5 to 11% at least, and I'd rather buy those than buy one that's 8.18% earnings yield. So that's not enough. But we can continue going through things to see, are there any factors about the bank that would change our mind with that, or that would mitigate that higher price. But just looking at it from that perspective, it seems like it's a little bit expensive. And maybe that's what we see also when we saw that the price earnings was 11. We saw it as being a little bit expensive, but we can carry on and see if there's anything that might change our minds. So we can see here, their bank subsidiaries. This is a Northern Bank. They've got life insurance company, financial services, and those are what pull in the non-interest income. But coming down here, skipping past this stuff, we can get to the securities. We can see, as is the case with most banks, we got the mortgage-backed securities are the biggest component of the securities portfolio. It's about 52% of the securities. The next biggest is the munis and obligations of states and political subdivisions, and that represents about 38% of the securities portfolio. And that's a lot higher than what we would normally see. For munis, it's usually 10 to 20% or so. So they're really allocating a lot more to municipal securities here. And thinking about it from a risk perspective, mortgage-backed securities typically are either implicitly or explicitly guaranteed by the U.S. government. So not a lot of risk there. Same thing for treasuries, government agencies. But then the munis plus the corporate securities here are might come with some risk. So it'll be interesting to see if there's any discussion in here about the risk of those securities, whether they're investment grade, whether there's an allowance on them, stuff like that. But we can see, as is the case for most all banks, there's an unrealized loss on the securities, but they're being available for sale, then all of that loss goes into the other comprehensive income, basically a component of equity. And if and when they sell those securities, and that hits the income statement as a loss, right? But if that never happens, then they just can continue holding it in equity until they're mature or whatever. So anyway, I think I saw in one of their 8Ks that they sold a portion of their securities at a loss. So maybe this loss is a little bit less than what we would see for an average bank. We'll be able to see that once we get into the fair value conversion. But speaking to the term structure, from this table we can see when the maturities happen for each of the corporate and muni securities. Not necessarily for the mortgage-backed ones because they don't have a defined maturity date, but this is helpful regardless, but we'll be able to see once we look at the call report what's the repricing timing of the securities when we're considering interest rate risk, the timing of when they reprice. So they speak a little bit to the unrealized loss here of about 52 million. They say that they don't anticipate selling the securities, so that loss might not be realized. But also they make note that a lot of the Well, the unrealized losses that we have here are due to changes in interest rates in the market, not necessarily credit quality. So they don't have an allowance on the available for sale securities, but also the ones that are munis, the ones that carry risk, the corporate ones, munis, private label, commercial, mortgage-backed securities. They say they're all investment grade, so there's no history or risk of payment defaults in their opinion, so there's no allowance on them. So, but in the grand scheme of the balance sheet as a whole, 75% of it is loans, and then 10% was securities. So, a small loss in securities might not be a really major blow to the bank. Of course, it's important, but most of the securities are in riskless securities, so perhaps not a big risk here, and maybe it's not a big deal. There's no allowance. Anyway, so coming down to the loans, which is the meat of our analysis and the meat of the bank, right? So we can see here, these two categories here, commercial real estate, a lot of it being also non-owner occupied, which is riskier than owner occupied. But, the commercial real estate represents about 53% of the loan portfolio, which is pretty high. We might normally see something like 33 to 42% of the portfolio being commercial real estate. But in this case, it's 52%, so it's a pretty high percentage, so there might be some risk here. I've been seeing it in a lot of banks. The ones that have a high percentage of commercial real estate typically have a lot of credit risk there. So we can see that here in a second, whether that's the case. They also have a lot of C&I, all of their commercial loans, put it in the C&I bucket. But it's about 22% of the loan portfolio, which is also on a bit on the high end. So, they have about 75% of their loans are commercial, and then the remaining, it looks like, are consumer-based loans. And the 75% commercial loans, is pretty average for most banks. So I wouldn't say that they are, highly allocated to commercial loans relative to how the other banks are. So, but still, there might be some credit risk here that we can take into account. Yeah, so it looks like most of their operations happen in Pennsylvania, but also maybe a little bit of southern New York State. So, but it seems like primarily Pennsylvania. So of course, the results of the bank's financial performance is highly dependent on the Pennsylvania region, and there's a lot of banks in Pennsylvania, so it's really competitive. And I believe the projections for population growth is pretty low. So there could be a risk of not a whole lot of growth there. So something to take into account. Of course, I can't predict the future, so I try not to hang my hat on those sorts of things. But yeah. But I can see the present, which is past due loans here, about nine. Actually, we have to add all these together, I suppose. So about a little over 6 million, plus about 19 million, plus 0.2 million. Yeah, so past due loans is about 25.9 million. That is 1.38% of loans. That's a really, really high amount. That's maybe double what we typically see. It looks like a lot of it is in the non-owner occupied commercial real estate. Also a lot of C&I. So surprisingly, a lot of residential mortgage loans as well. I think that probably is a higher percentage because there's less residential mortgage loans in their portfolio, so it's a higher percentage of them. Or or at non-accrual. Anyway, so this is basically, double what we would typically see, so that's a big risk. Same thing for non-accrual loans here, which is just the 19 million. That's about 1%, and that could be somewhere between 2 and 3 times what we typically see for non-accrual loans on the average bank. So it seems to me there's potentially some issues with the credit quality. And coming down to the credit quality indicators, we typically see how much of their loans are classified, so substandard and worse. And if you were to add all these up, it would be 49.9 million of classified loans. So that's substandard plus doubtful. And those are the ones that they've identified a specific issue where it makes it more likely that the loan is not going to be paid back in full. And so 49.9 million of the loan portfolio is about 2.67% of the loans, and that's a lot. That's it's basically double what we would typically see for the average bank. So looking at the classifieds plus the past dues plus the non-accruals, it seems like this bank's credit quality of its loan portfolio is twice as bad as the average bank. So in that case, I would want to see that their reserve is at least twice as high, right? And it's very rare to see a reserve that would be, I don't know if I've seen a reserve that would be twice as high as the average for all the banks. But let's get past some of this stuff to see if we can get to the ACL. Here's the collateral dependent loans, about 14.8. That's about 0.79%, and that's higher than the average range as well. So collateral dependent loans being ones that the customer is more than likely going to be paying off the loan with the collateral, as opposed to paying down the loan in the normal course of business, right? So anyway, we got the ACL here, which comes to 20 million, and 20 million is about 1.07%, which is actually less than the average range that we would see for a typical bank. So, wow, unfortunately, it looks like they have double the credit risk, but their reserve is below what we would typically see. So it seems like there could be issues going forward of either needing to increase the provision, which would hit the income statement, or write off a lot of loans that aren't currently reserved for, and that would also hit the income statement. So we have a big risk here that net income will go down as a result of poor credit quality. And by our analysis previously of the profitability, where we see that the price of the bank was a little bit too high for its earnings based on an average bank, but then this bank having higher than average credit quality or higher than its average credit risk makes the bank seem even more overpriced, right? So anyway, so we can move on to other parts of the footnotes and see how is the interest rate risk as well as the capital and liquidity and all that kind of stuff. But as it is with the poor credit quality plus the poor pricing on the earnings, it doesn't seem like a bank that we would want to buy so far. But let's keep on going. So as far as the borrowings go, we had 48.8 million of short-term borrowings. Yeah, so all of them are FHLB, and a little bit of repurchase agreements, but not a whole lot there. So short-term means that they're going to mature within the next year. So those are ones that when they mature could reprice into higher higher yielding debt, or if they don't re renew it, it just might go away. But we also have the long-term borrowings here, 148 million, but it looks like at least 26 plus 44 matures within the next year, depending on when during 2025 it happens. But about 1 year or before, so or 1 year or a little bit after. So those will reprice, and then we've got some more longer term here that look like they reprice somewhere within the next 1 to 5 years. So it's a really small amount relative to the balance sheet as a whole. So not a whole lot of repricing risk, I don't think. We'll be able to look at it in the context of the full bank assets and liabilities, and how each of those things reprice a little bit later. But as is, these interest rates are fairly low. I feel like I've been seeing some FHLB borrowings in the 5%, so pretty good rate. Also, the senior notes here as well, and the subordinated debt. These are pretty small amounts as well. 14.8 million, and it matures in 2026, as well as 25 million of subordinated debt, which is fixed to floating, but becomes floating in 2026. So most of their debt reprices in the 1 to 5 range. It seems like, which is good for interest rate risk. And it's also at fairly low interest rates, right? At least now. Once it reprices in 2026, it'll probably be at a lot higher. But currently 3.25%. It's a fantastic yield. So moving on from that, one thing that just happened, like March 27, 2024, they were sued by some investors that happened to invest in a Ponzi scheme, and the perpetrator of the Ponzi scheme was a customer of the bank. So those investors are suing the bank as well, and they say that they don't feel like that they are going to have any they have substantial defenses, and they don't think there's going to be a loss. But you never know with this kind of stuff, and it could be pretty expensive for attorneys to pay to defend them, and it could drag on for years and distract management and all that kind of stuff. So it's not very typical to see something like this. I mean, when we analyze most banks, most of them have some kind of lawsuit around overdraft fees or something like that, but we don't typically see a lot of these obscure types of lawsuits. So never know where it'll go or how much it'll cost. Even though they say that they don't expect much and they haven't accrued any expenses for it, it could end up being expensive. It's not something we can predict, obviously, but just something to keep in mind down the road. As we're thinking about the profitability. As far as the derivatives go, they don't have any hedges. They're all back-to-back derivatives where they do a swap with their customer to let their customer have a fixed rate on a loan, perhaps. So they originate a floating rate loan, and also originate a swap with the customer where the customer can get a fixed rate. But now, to mitigate that risk, the bank will do an exact opposite swap with another counterparty to offset that swap they created with the customer. So it basically has a net zero effect on the balance sheet and the income statement and stuff like that. So we usually ignore that. It's just kind of a means to facilitate their customer and keep that floating rate going on, which is the way I prefer. floating rates on the assets, or at least assets that reprice pretty quickly. So, given that the nature of banks are inherently liability sensitive. Anyways, so coming down to the fair value measurements, we can compare the carrying value on the balance sheet to the fair value that the item actually is. And as we already talked about, the securities they have are available for sale, so they're already at fair value, so there's not a difference there. So really the only difference here is going to be the loans, which we can see, 1.85 billion is what's on the balance sheet, and then the fair value is about 1.77 billion. So a little bit of a decrease. There's also usually a few differences in the types of debt or deposits that have maturities or terms, and so see a little bit small difference with time deposits and some of the debt, but not a whole lot there. So if we were to convert everything to fair value, it decreases equity by about 30%. So this loan, the value of the loans decreases the equity of the bank down a lot, 30% down. Even though if these had been held to maturity securities, it probably would have decreased it a whole lot more. But anyway, so we look at that in relation to the market price of the bank, right? So if we look at the net assets at fair value, assets minus the liabilities, and compare it to the market cap of the bank, we can see sort of what's a price, what price am I paying for the fair value of the equity, and that comes to about a 2 times multiple, which is about in the middle of the range. So we typically see somewhere between 1.5 and 2.5 times of price to market value of equity, basically. So it's interesting to think about, because you look at the price to book ratio on something like the Yahoo Finance page, and it's 1 times, but you convert everything to fair value using this, and it makes that price to book ratio double. But all banks are in the similar situation where as interest rates have gone up, the loan values have gone down, the security values have gone down. So the price that we're paying for these the banks at their fair value of equities, it's about 2 times, somewhere between 1.5 to 2.5 times. So I would say it's a pretty average price for the net assets of the bank. We also look at this from a capital adequacy standpoint. So converting everything to fair value, we can get the fair value of the net assets divided by the fair value of its assets, which is basically the same as common equity ratio of a bank, but at fair value rather than the carrying value of the balance sheet. And so this equals about a little over 5%, so which is within the range. So we would typically see somewhere like 5% to 7%. So I would say that the capital of the bank is about average relative to other banks. Just looking at this crude measure from converting everything to fair value and looking at a kind of a common equity ratio. So that's great. Perhaps there's some pretty good capital in place, and maybe it's adequate. But yeah, so it looks like we're in the MD&A. We can explore a little bit more about what's going on. We typically like to come down to where it shows the yields, and it helps us understand a little bit better about where why the income statement is what it is. Now I can see the securities are yielding about 2.41%. That's pretty low, I believe. So yeah, I mean, we would typically see somewhere around at least 3% for the securities, over the past quarter or so. So 2.5% is pretty low yield on the securities. And then as far as the loans go, 5.92%. It's probably about average. So, fortunately, the 75% of the balance sheet is loans. So that puts 5.22% earnings yield. I feel like that's pretty, yeah, that's within the average range of the past year of banks, but interest rates have gone up since then, and the repricing of the loans have gone up since then. So I feel like that's pretty low for this quarter for banks. And so, I believe we saw an interest income of about average for banks, right? So, but I think it's a little bit on the low end as well. So something to think about. Once the loans reprice and the securities reprice, then they might reprice at higher yields. But currently, it's at pretty low yield, and we can probably look at. Yeah, so the yields have gone up by a little bit, but not a whole lot. It hasn't been a dramatic increase over the past year. Meanwhile, I think a lot of other banks have seen a pretty dramatic increase in their earning assets, which would be a function of the repricing timing of the assets as well. So, maybe this bank, the repricing didn't happen as quickly. But, on the deposit side, I think the deposits at least earn a pretty, or they yield a pretty average yield. Somewhere around what, two and a quarter or something. That's pretty average. Savings accounts basically yielding nothing. That's interesting. But the time deposits 3.61%. That's probably about average as well. So pretty good cost of funds here. And then if we take a look at the debt side as well, as we talked about, the FHLB loans are pretty low, or the yield on the FHLB is pretty low. I've seen some lately that's been in the fives. So those yields are pretty beneficial. And then the total interest-bearing liability is 2.6%, which is it's average, but maybe on the low end as well. So so that equates to a pretty good net interest income. So we've got about an average earnings loan yield, but perhaps a lower cost liability side, and so we're earning pretty good money on the net interest income side. It's just kind of unfortunate that the non-interest expense is sort of cutting into a lot of that. But we did see that they've got a pretty average net income. It's more or less the price of the bank that's deterring us, not necessarily that it's a bad bank, right? And aside from the credit quality, which we talked about a second ago, but it is making good money currently. So kind of skipping over a lot of this that we've already talked about. We usually drill into the financial condition pretty closely. So for efforts of time, we can skip through. We can see the non-performing loans as a percentage of loans pretty high. It's probably about double what we would typically see. And then allowance here, 1.07%, is also pretty low. You can see over the past several years they've had to continually increase it, which eats into the net income. Anyway, so getting into the liquidity here, I like it when they give sort of a little easier to follow chart about the availability of wholesale funding. That's super helpful. But when we initially looked at the balance sheet, we saw that they've got a lower amount of cash than what we normally see. The securities are a little bit on the low end as well, so we sort of guessed that there would be a little bit lower liquidity than what we typically see. And that's the case. We've got 46 million of cash, and then about half of the securities are pledged. So that leaves about 200 million of unpledged securities. And so, cash plus unsecured securities or unpledged securities is about 250 million, which is about 12% of deposits. So, that's on the lower end. So, I would say that the liquidity of the bank is, not bad, but also, a bit below what the average bank might have. But when you throw in the availability of these different funding sources, like I can see they've got 713 million they can borrow from the FHLB, 19 million they can borrow from Federal Reserve, and then they've got some correspondent banks they can borrow 75 million from. So, they've got some off-balance sheet liquidity here that they could draw down on if they needed to. And, putting all those things together, in addition to the unencumbered loans, which, they've got about 71% of the loans pledged. So, there could be up to 29% of the loans, depending on what they are and if they qualify for securities or for the collateral. But that equals to about almost $1.5 billion that they have of on-balance sheet liquidity plus off-balance sheet, and that's about 73% of deposits. So that's within a normal range, a little bit on the low end, but so I would say that, based on, I'd also like to look at the regulatory ratios as well, but it seems like that they have, an adequate amount of liquidity, an adequate amount of capital, especially when we think about from when we converted everything to fair value. We could see, the fair value of its equity divided by its assets was an average amount. So I could see that they have pretty average amount of liquidity and capital, and that makes it adequate. They reiterate a lot of that here. So here's the regulatory ratios. So consolidated. So about 9.88% of the leverage ratio, and then common equity tier 1, 13, tier 1, 13, 15 total capital. And I think those are pretty average, if not on the higher end. So let me check. Yeah, so leverage ratio is about average. Tier 1 total is about average. Total capital is a little bit on the higher end. So anyway, this is almost also evidence that, perhaps they've got some adequate capital in place. So I feel pretty good about the capital and liquidity, keeping the bank, operating. From an interest rate risk standpoint, let's see what they have as far as their projections for changes in interest rates. This is economic value of equity. So I want to use 2024 data. Oh, I see. So net interest income change if there's 400, 300, 200 basis point increase. Okay. Oh, that's interesting. So basically, no matter which way interest rates go, their net interest income goes down. That's not good. That's an interesting position to be in, where no matter what you do, or no matter what the market does, you lose money. Or not necessarily lose money, but make less money. So we can sort of, we typically look at the call report and see the repricing of the securities and loans and deposits and debt. And I can see that, basically the security, what percentage is this? So 76% of the securities reprice after 5 years. And that's a lot. It's pretty high amount. In addition, about 77% of the loans reprice at least a year from now, and that's a pretty high amount as well. So it looks like, from the asset side, um, there's a lot of assets that reprice later than average, and so that would be a risk to us from interest rate perspective, because if interest rates go up, the assets don't reprice to give us higher interest rates down the road, right? Um, and so, that's a big risk there. And if we look at it from the deposit side and the debt side, it's pretty average. Like, as we talked about, there's about 25% non-interest bearing deposits. So, those of course don't reprice, but there's a risk that they migrate to an interest-bearing account, right? But that 25% is pretty average for most banks, and that we talked about earlier. So the repricing of the deposits is pretty average, pretty normal. Even the time deposits that reprice within the next year is pretty average as well. So yeah, and then from the debt side, the debt helps us out having those subordinated notes, because they reprice in 1 to 5 years from now, right? But there's not a whole lot of those, right? So only what was it, 150 million or so, like that. So that doesn't push the liability side of things far into the future on a materiality standpoint. So we have a big risk here with big interest rate risk due to the loans and the securities repricing after a year. Most all of the loans and securities, and we don't have any hedges to offset some of that risk as well. So and then the liability side of things repricing within a normal average timeline. So if interest rates were to go up, or if the bank's interest rate yields on its debts and assets haven't yet caught up to the current interest rates, which is the case, then they're going to get squeezed on the net interest income. So even though we saw that the net interest income is doing well on the income statement, they're making a good average amount of net interest income. I feel like due to these repricing risks, if they don't restructure their balance sheet in some way, they're going to get squeezed a little bit on the net interest income. So that's a risk as well. So ouch, that's unfortunate. There are some things that the ALCO, the Asset Liability Committee, can probably do and put together to prevent that from happening. So it's not something that's like certain. Hopefully they've identified it and know and understand the risk, and put steps in place to perhaps mitigate it. But as the balance sheet is structured now, I feel like the interest rate risk is too high. So, but anyway, so this is the end of the 10Q, and we can now kind of summarize what our conclusion is. But I think you already know what it is based on some things we've discussed up until this point. But we saw that it's pretty average profitability bank, which is awesome. I'm definitely willing to buy a bank, an average bank, at an average or better price, right? So, but as we started digging a little deeper, we started to realize a lot of the risks that are occurring as well. But so anyway, the bank average profitability, and it had really good net interest income, really good non-interest income. Non-interest expense was a little bit higher, so those two good qualities from net interest income and non-interest income were offset a little bit by a little bit higher non-interest expense, which put them kind of in an average profitability, which is awesome. And they actually had, the liability side of the income statement seemed like it was at a lower funding cost than what we would typically see for the average bank. So that's awesome. But, from what we just talked about with the interest rate risk, we did see that, the liability side of their balance sheet reprices about in the average timing of what we would see for most banks currently. But the asset side of the balance sheet, the term structure reprices farther out than what we'd see for an average bank. So that means that the liability side of the balance sheet is going to reprice faster than the asset side, or at least faster than what the average bank might have. And so that could possibly squeeze the net interest income, or at least squeeze it more so than what the average bank might be squeezed going forward. And we could even see, like within the MD&A and the market risk section, where no matter which way the interest rates go, they lose money, and that wouldn't be fun, right? So I feel like that's probably not a risk that we would want to take on unless we could buy the bank at a price that compensates us for that risk that we're taking. But as far as the capital liquidity risk, we talked about that they. I feel like they're in a good capital liquidity position. So as the bank has a going concern, I don't think it has any risk. They had the on-balance sheet liquidity perhaps was maybe a little bit on the lower end, but not. It's not like they were hurting for liquidity. And then adding in the off-balance sheet liquidity, they've got the ability to borrow from the FHLB, Federal Reserve, and that puts them at about an average of what most banks are positioned to do. So and also converting their net assets to a fair value put them in a pretty good within a normal ratio of the fair value of its equity to its assets. So I felt like the capital and liquidity position was adequate and average with what we would see for most banks. Now, finally, the credit quality, as we saw, they've got a lot of past dues, a lot of non-accruals, a lot of classified loans, basically at least double of those of what the average bank might have, and possibly almost triple what the average bank might have in those categories. And then their reserve for loan losses was less than what the average bank might have. So not only is their loan portfolio does it have poorer credit quality, but they also have a lower reserve than what most banks have. And so I feel like in the future they would have to potentially increase the reserve, which would come in the form of the provisions, right, which hit the income statement, and so that would hurt the income statement as well. So currently we have an average profitability bank, which is awesome, but we have the risk that due to the poor credit quality, we might see the net income decrease because of the provision for credit losses. But also because of the interest rate risk, repricing risk, we might also see a squeezing of the net interest income. So those two risks would directly affect our income and could put it in a position that's below the average bank's net income, and that's not what we would want to achieve. So so as it is, we would want to have a pretty cheap price on the bank for us to take on the risk that our net income might decrease to a point that's below average, poor net income, right? And currently as it is, the market price of the bank, which is about $260 million, if we were to compare it to the current earnings, our earnings yield was fairly low. And it ended up being about 8.18%. So that's a really low earnings yield, which would mean that the market price is a little bit higher for those earnings than what a typical bank would be. And so it seems like not only would we be paying an expensive price for those earnings, but also we have all these risks that the earnings could go down in the future as well. And so it seems like this wouldn't be a very a bank that we would want to buy. It doesn't seem like it's a fair price for what we would be getting. So yeah, that is my conclusion on that and our analysis. Definitely leave comments if you would like to add anything that I might have missed, or let me know that you agree or disagree with my thoughts. I'd love to hear what you have to say. And yeah, so thanks for listening.